Welcome back. You're watching Markets at Noon on ET Now. Well, let's address the earnings of CARE Ratings. We have with us Ajay Mahajan, MD and CEO of the company, joining us on the show. Mr. Mahajan, thank you for taking out time. To start with, could you brief us about the quarter gone by, the key highlights?
Look at the quarterly results for this quarter. As you are fully aware, the macroeconomic backdrop for this fiscal has been a little challenging. And within the challenges that we are all facing collectively, considering rating agencies are essentially a mirror for the economy, and certainly so a mirror for the credit growth in the system. We had very muted credit growth. So let me just first jump to the numbers. The numbers for the quarter are, on a consolidated basis, CARE Group has posted 64 crores of total income for the quarter. And on a standalone basis, CARE Ratings has posted 55 crores as total income for the quarter. On a PAT basis, a consolidated PAT for the all CARE Group entities is 19 crores. And for standalone CARE Ratings, it's 16 crores for the quarter. If you look at all the numbers on a 9-month basis, the numbers are 195 crores total income. And on a standalone basis, 177 crores income for CARE Ratings. And on a 9-month basis, the PAT earnings are 64.5 crores for 9 months versus 63.7 crores on a standalone basis in CARE Ratings. So this is a summary of the financials. I'll be happy to take any other questions.
Okay. Mr. Mahajan, what's your view on recovery across sectors? How are you seeing credit recovery shaping up in the upcoming quarters?
We have always maintained that for ratings business, like I said, firstly, let's go to the first principles first. The ratings business is essentially a business that feeds off the economic growth, and within that economic growth, it feeds off leveraging the credit growth in the system, whether through bank loans or through capital market instruments like bonds or commercial paper. Now, as we all know, we're talking about a 7.7% economic decline in growth this year. And credit growth this year has been marginal. I won't get into numbers like credit to manufacturing is 0.5% growth over last year, and in the quarter that is, and to services is also marginally up or down. So we were discussing -1 to +1% growth to industry and credit growth to industry and to services. So essentially, we have had a very tough year. Let's first take recognition of the fact that this is a very tough year from a leverage point of view. All other sectors of the economy play either on consumers or they play on certain commodity growth and certain, you talk about steel, you talk about infrastructure. They have very different client segments and different demand pull factors. For us, our growth is directly a function of credit growth in the system. And obviously, in a tough year, the credit growth is challenged. Having said this, I would keep very positive outlook for next year. We're not commenting necessarily on Q4. Q4, we'll try to do our best under the circumstances, but basically next year onwards, given the path-breaking union budget, I personally feel very happy that this is a structural shift in the thinking of the government. This is a structural shift and directionally a very positive budget. And I remain exceedingly hopeful that there will be private sector will come forward and start making some investments in the economy. What we need is more investments in the economy in form of projects, whether greenfield, whether brownfield. Government is doing its job. It's increased its capital expenditure for next year. We are hoping that private sector will follow suit, and hopefully as a result of that, ratings business next year should do well.
What is the outlook then for FY22? Where does the focus lie?
I have been saying this ever since I took over on 15th of April 2020, that CARE Ratings is absolutely a transformation story. There were good things in the company, but we had to obviously work on many other things and focus on quality. I have been saying this, and very incessantly the board and the management have been working on improving the quality of our ratings business, our processes. The second big thing that we will focus on going forward is, once we are addressing the quality across the board, we will be focusing on growth. Growth in the company is an absolute necessity. Ratings business, as you know, is a regulated business. the CAGR of this business remains somewhat controlled. And the reason for that control is that despite economic growth and massive debt leveraging, sometimes the regulated businesses there are 7 rating agencies in the country. There is extreme level of competitiveness in the industry, and therefore the rating revenue pool somewhat remains contained. So while we will do our best in the ratings business, Upasana, we are also looking in the future for growth in our research and analytics business. We have made some investments already. We've got a new CEO for our subsidiary in advisory. We believe that the advisory, analytics, and research businesses have significant upside from here, and there is always room for a competitive player to come in and build market share in that business. So for me, there are 2 parts to this company. There is the ratings business, which is a regulated business. We will do our best within that business to launch new products. We have already won 2 mandates in REITs, we will get into more structured finance and capital market instruments quite assertively. We are building bench strength and capability in that space. And also the non-ratings businesses, where we believe that we can leapfrog to being a reasonably smart data analytics company led by more sort of state-of-the-art technologies like artificial intelligence and machine learning.
Budget has sent positive signals and key focus has been laid on growth. How would you see economic activity shaping up post the budget announcements?
The government is doing its job. It's increased capital expenditure next year to 5.35 lakh crores, if I'm not mistaken. And on top of that, there is a very good announcements around increasing the flow of private sector capital into erstwhile sort of sectors where government has its investment traditionally. There are massive announcements around disinvestment, around privatization, around taking public sector companies to private sector, around selling state utilities, whether those are NHAI utilities, which there may be some assets of the state that could be monetized next year, or it could be the announcements around monetization of stakes in certain state-owned entities, which could lead to a significant amount of cash flows for the government. So on the government side, I believe the government has put its best foot forward. I truly believe now that the private sector needs to also come off its some sort of reticence, some sort of diffidence in the last few years, and we understand the reasons for that. The economy was indeed going through a very volatile phase. But I think now, with this very strong direction set by the government, we believe that the private sector should come forward and make investments. And only if they come forward and make investments will we actually see a significant uptick in job growth and economic activity. Overall, the Reserve Bank of India policy sets a direction towards next year growth at 10.5%. We believe we can even outperform that should the investments start coming in.
Okay, Mr. Mahajan, thank you so much then for joining us on the show.